Welcome to the Secret Stash.
That's super secret.
And this is the only show that tracks down the local people behind the places and things we love.
I'm going to kick it off with my favorite thing ever.
Then goes deep to reveal the best kept secrets behind them all.
Why aren't we talking to people? Let them know. Shout the rooftops. This is great.
And leave you with a stash of stories and offers you'll only find here. Now, here's your host, Jesse Ibanez.
Secret agent man, secret agent man. They've given you a number and taken away your name.
What's happening, San Diego? ESPNites. My man Will Maldonado just dropping some sports with the $S. And now we got you for the 1 to 2 o'clock hour right here. This is the Secret Stash, and I am the secret agent man, Jesse Ibanez, co-founder of the Greenhouse Group. And we got some of the coolest local people tracked down, doing some of the coolest local things with Real Talk Radio San Diego. And my man, I'm flanked today by, you're kind of a big deal, at least in my circles that I swim in. And you may have heard of him. His name might have preceded himself. Jake Sutton, of course. Edward Jones Financial, my man. And, we're not just going to talk shop money today. We're actually going to kind of get into the weeds a little bit because Jake's got some things that he wants to share with you. Things that maybe you might not be looking at right now in your financial plan that Jake's saying, hey, man, if you don't, it might be looking out for you. And if you know what I mean. Jake, but before we get into that stuff, man, why don't you let the people know who you are and what you're doing over there?
First of all, Jesse, thank you so much for having me on your
Secret
Stash show. We've been talking about having me on for a while now. I'm just really happy to be here today, so thank you.
Yeah, well, you're one of those dudes who it's tough to track down, so we're all very blessed over the next hour to get to tap into some of your infinite wisdom. But on that note, though, so I mean, what differentiates you from any other cat that talks numbers and tries to build wealth out there in San Diego?
I think, first of all, I just want to throw a shout out to Diana Clark, who is my senior branch office administrator. So not only when you hire myself at Edward Jones, you get Diana as well.
I see what you did there.
She's just the sweetest. She's the best. All the clients love her. So number one, I would say Diana sets us apart. And oftentimes Diana will take a break. She has to go on vacation as well. The clients are actually upset when she's not there to pick up the phone. Like, what did you do to Diana? I said, the lady gets 4 weeks off a year, so please, she has to go on vacation as well. So right there, Jesse, that level of service, both with Diana and myself, I talk about the investments, the plan, doing those financial assessments and portfolio reviews. I've got Diana on the other side. She's taking care of the paperwork. She's there for any of those other types of administrative items that you need. And I think Edward Jones, that has really set us apart of having that teamwork. And that's what our clients are telling us that they really enjoy about working with us.
Well, and what I'm hearing you say, too, is it's also an opportunity for us to all get kind of a peek-see into how you see this, the purview, you might say, that it's not about you.com, you're a we. And the client experience, and I know this to be true because I've been in your graces now for quite a while. The client experience is really the reward, and that's part and parcel to both of what you guys do and the Edward Jones philosophy, which seems to work and merge and marry in really well with who you guys already are.
We're definitely, our tagline being making sense of investing, and so many times when you see something that's happening in the financial world and it doesn't make sense, we're there. We have timely insights that we can help you kind of navigate those markets, especially when they get turbulent.
Well, and that's exactly what I want to pick up on. So if you'll allow me, I want to get right into this because there's a lot of stuff going on right now. There's chatter. Like I hear a lot of people say, oh man, the market's super overinflated right now. Like it can't really stand on itself. Where are these numbers? These numbers are crazy. Wait, what's the market at right now? What's the close at right now?
Wow, I could probably get my Bloomberg app out real quick. We're close to 18,000 on the Dow Jones Industrial.
Right.
Yep. So.
I remember back in the day, not too distant past, where if you were up into the 5 figures, it was a big deal, right? So anyway, this is great for a lot of people in a lot of capacity. Also, is as a challenge that creates Well, it's a great thing that creates challenges. Maybe that's the thing. There's good challenges and there's bad challenges. We'd rather have good challenges, but still challenges nonetheless. So what I did is I'm going to throw you in the hot seat here a little bit, Jake. I grabbed a couple things that I've been hearing people talk about, and I'd like to just get your take on it, as deep or as 30,000 foot as you want to get. I know that if you're catching us right now, you're in a spot where it's like, hey, maybe somebody moved the cheese already, where you thought you had stuff allocated, that might have been shifted a little bit. I know one of the greatest gifts you've always given me, Jake, is letting me know where that stuff is, so you might call it an annual review or a checkup, or I might just pick up the phone and call, but you'll be like, hey man, this is what we had in mind, and now this is what's happening now. So like, how are your investments allocated right now is a big piece of that, right? And then
Correct.
like, hey, what are the returns getting? Like, are they still up to snuff? Is that all still working? So if you allow me with that container, a couple things. So first, let's talk about oil. Okay. And I could even just say that colon and let you go with it. But more specifically, like, are lower oil prices ahead?
And I will just point out that Jesse is reading off one of our U.S. market insight reports here, and it's 7 road signs for investors, and that's available on our website at edwardjones.com. So it is one of our insight reports you can go to, but I think the reason that that's number one is it has been much in the news of declining oil prices, and what that means for the markets. And in that report, we have gone back in time and seen when the price of a barrel of oil has fallen more than 50%. And typically after those periods, we've seen good investment returns follow. A lot of that has to do with, because we are a consumer-based economy, it's more money in folks' pocket, especially individuals, but even businesses that have that, if delivery is in their business, and most people do have that, they have to make a shipment, that low oil prices can help lower the cost to both businesses and individuals.
So, how does that work itself into someone's financial plan then?
I think certainly investors are looking at that as potentially being a good sector of the market for value right now.
Right.
If they're thinking that perhaps in the future oil prices will move forward, again, I would caution everything in its right place. So you want to make sure that you're not overweight energy. If you were overweight energy last year, certainly that part of your portfolio has declined. So it's all about making sure that you have the right allocation for your risk tolerance and your time horizon.
Yeah, that's beautifully said too. And this report that you're talking about though, but you don't know which ones I'm going to ask though. So that's the hot seat part of it.
Fair enough.
I'm going from the chatter that I'm hearing live, and hopefully we can get to as many of these as possible because I know they're all technically important. And if you want to grab this report, you probably want to go check Jake out. And you're probably dropping him an email is the best. It's your first and last name, right? So Jake, Jake Sutton, 2 T's, Sutton at edwardjones.com. Is that correct?
That is correct.
Okay, good. Yeah, so we can check him out. Or you can get all this information generally on the edwardjones.com website. So moving on a little bit. So I think we primered that enough. Let's just get right into the actual stock market itself, right? So like, how would you frame this concept of like volatility returns as it pertains to coming up with a solid plan?
I definitely think we have to put market declines and advances in perspective. And typically, you're going to see a correction, which is a 10% decline from top to bottom. You're going to see that typically about once every year. And we have not been experiencing normal volatility through 2012 and 2013. We had a little bit more towards the end of 2014.
Now, would you say that was sustained? Like I think I take a page for myself. Like, of course, helping folks buy and sell homes. We've seen some pretty outrageous jumps over the last 3 to 4 years too. And a lot of the pundits say, well, it's largely because of it was so troughed out to begin with. It wasn't a typical market cycle, right? It was so far down that it had to do all these gains. So you were like the concept of getting back to zero. Now, could that be analogous to what's taking place in the stock market too? That's kind of creating some of those returns?
Somewhat. So if you take a look at our report, there is a section about GDP growth and also those market ups and downs. And certainly we haven't had the kind of sustained recovery coming out of that deep recession that we had in the past. So conversely, we're still trying to increase that growth of our economy. And I think it has been perhaps that 2012 and 2013 upswing without a correction. Potentially that could have something to do with that. But I think we are expecting that the market will return to that normal volatility. So we're definitely cautioning our investors that a 10% decline most certainly could be in the offering. And I think looking at where your portfolio is allocated, making sure you're comfortable with how much risk you're taking on right now for, again, your risk tolerance and time horizon.
Yeah, that resonates deeply with me. And the other thing that comes up, I think, almost naturally, just sort of organically rises up inside of what you said is the concept of liquidity, right? So, and you correct me if I'm wrong. I mean, you're the guru here, the guide by my side right now. When that volatility, when you're trying to hedge for that, and you mentioned the 10, is it not then wise to kind of pull back a little bit and then get a little liquid to be able to kind of offset what you... I think about like the old Vegas thing. If you ever walk into a casino, in small writing, be it on the top, it says, never gamble more than you can afford to lose. Right? Is that kind of the same concept as it pertains to liquidity?
We certainly do not want to talk about investing like walking into the casino at all.
Right.
So we are investing, not gambling. But certainly what I have found with folks, as far as their cash savings, let's say, they throw it out there to have 6 to 12 months of expenses that is in some kind of cash investment vehicle.
Yeah.
And I do find that people don't have enough cash savings. And if you don't have enough cash savings, that's certainly a well-laid plan with maybe your retirement savings. If you're not comfortable and you don't have that 6 to 12 months, or let's call it an opportunity fund, most certainly you'll probably be a little bit more emotional when that 10% correction happens. So I think from that standpoint, before you go to do any kind of longer-term investing, we need to make sure that on the short-term side, the 6 to 12 months out, that you have that safety cushion built up for sure.
And I'll tell you from personal experience too. So, call this a shameless plug, or if you will, or whatever. But I remember that was one of the things that impressed me the most about you is that when I first sat down and met with you, you took a look at my reserve basically, and you were like, you know what? I love the gumption here. I love that you're trying to get this whole party started, so to speak. But I'd like to see you have this first before we started doing that. And it took me a little bit of time, took some discipline, but we got there. And now I'm able to invest comfortably because I have that. I love what you call it, the opportunity fund.
Correct.
Yeah, it's genius. And that's tough, man. It takes, like I said, a lot of discipline to be able to put away 12 months of, and that basically means if everything stops today, my liquid reserves would be able to carry me at least 12 months forward.
Especially with, if you read the back of that report, money markets at a very low historical cash interest rate, at 0.01% at the bank. It is really hard looking at that money, feeling like it isn't working for you, but it's so important for those times. And again, it will allow you to, with those market volatility, when it does happen, it'll allow you to weather the storm, so to speak.
That's my man, Jake Sutton from Edward Jones Investments. And you can catch him, of course, online, edwardjones.com, or him personally at his email, jake.sutton, 2 T's, 1 N, at edwardjones.com. Or you can call him or Diana directly at 619-235-4219. And coming up, we're going to talk a little about stocks and what inevitability you want to have in your portfolio if they keep rising. And then the economy a little bit. Is it accelerating? Is it decelerating? A little bit more about that coming up. My man Jake Sutton. We'll be right back. Real Talk Radio San Diego.
Don't blame it on me. Don't blame it on me.
Be sure to check out our website, secretstashradio.com, for free swag and special offers just for our listeners.
When I met you in the summer.
Welcome back to the Secret Stash with host Jesse Ibanez on ESPN Radio 1700.
Hey, what's happening, gang? You are live in the Stash, San Diego's coolest local people doing some of the coolest local things. And we're talking money right now. We're talking planning. We're trying to get our arms wrapped around. I know it's the end of the first quarter already. I know you're supposed to do this at the beginning of the year. But if you're like me, you always need this stuff, right? Especially with all the volatility going on in the market. So for that reason, we are flanked by my man, Edward Jones's own Jake Sutton. You can always catch him, by the way, at 619-235-4219. 619-235-4219. And in the last segment, we were just getting going on this concept. You called it the 7 road signs. I call it the hot seat. This is some of the chatter going on right now. We talked about oil. We talked about basically the concept of parking your money with volatile returns and all the stuff, whether you want to be liquid, hedge back. What I want to try to get into now is actually the belly of the beast about stocks themselves. Okay. Now, I was just reading through this thing in preparation for our time together. Did I read this correctly? U.S. stocks went up almost 14% last year.
That was the S&P 500.
The
so
S&P.
The biggest 500 companies in the U.S., and that return was 13.7, I believe.
13.7.
Yeah, and that's after north of 30 in 2013. So we've had very good returns in U.S. stocks over the past few years.
So can they keep rising?
So our take on it is while U.S. stocks are slightly above their averages as far as a price-to-earnings ratio, that they by no means are significantly overvalued. So we do believe that stocks can keep rising, and that goes back to those GDP numbers. As the economy continues to heal and grow, people go back to work. Let's throw that lower oil price into the mix, and we have probably some more gains ahead of us. Will it be as nice as the past couple of years? Nobody has that crystal ball, certainly. So we do believe that U.S. stocks can continue to rise.
But they have been nice. And I want to get to more about the economy in a second. But, if someone's trying to kind of pinpoint this thing and say, all right, so, man, that's a big jump over the last 2 years. That's a chunk of change, man, percentage-wise, that's going on. So, whether you can still find good deals in the U.S. stock market, is there any areas, like I hear people talk about overseas a lot. So is that kind of like where you start shining lights around a little bit to come up with good picks?
Certainly, when you've seen U.S. stocks outperform, like they have the international markets, historically speaking, moving forward, international has done well versus U.S. And if you're looking for an area that perhaps is at a better value, consider adding international stocks to your portfolio if they're not already there. So certainly, again, in that report, you'll notice we've did the research, and after a 10-year period where U.S. stocks have outperformed, typically international outperforms moving forward. I will caution, in 2013, that was another thing that was on our radar for 2014, and again, U.S. stocks outperformed again. And actually, if you'll see, developed international stocks last year declined.
Yeah, I was going to ask you about that because is the corollary in lockstep, like as U.S. stocks do well, international tends to as well? It's part of that whole confluence of circumstance thing, or is it like an inversely relational situation where like there's only so much money to go around and it's kind of finite? So if we do really well, they do, because they were down almost 5% last year.
And if you had a well-diversified portfolio and you're looking at your statement at the end of last year, and obviously, if you had diversification, you probably did not have a 13.7% rate of return. But again, cautioning what investors in the past have done, have kind of chased return, or more where you were leading into is not doing a rebalance. So maybe you are overweight in U.S. stocks, and you need to look at some other areas like international to bring your diversified portfolio back into balance. I certainly think that it's a good time to take a look at that.
So what I heard you say just a second ago is that you believe that, or at least the general wisdom, no one knows anything, right? The man who knows something knows he knows nothing at all, but that there's still room for growth in the U.S. stock. So with these numbers of international stocks down 4.9%, you think that there's room for growth in there as well?
Actually, if you look at the numbers this year, the international markets have outperformed the S&P 500. So that large, diversified international part of your portfolio is doing quite a bit better than the overall broader U.S. market year to date. And again, who knows? But right off the bat in our insight report there, your international has definitely been a tailwind for your portfolio this year, where it set you back a little bit last year.
Well, so what changed?
Well, obviously, the European Union is doing some stimulus. We're tapering our stimulus back, and they've begun theirs. Again, also, we are seeing some healing over there in Europe. And frankly, they have large, diversified international companies themselves that generate most of their revenues outside of the Eurozone.
That makes sense.
Anyway.
Well, yeah, no, I mean, I'm sure we could riff on that. But yeah, what I want to try to do is kind of bring it back domestic right now. And I'll talk about our economy, right? So would you say that, I guess part and parcel to the point you made about stocks still having room to grow, would you say we're still accelerating?
Here's my shout out for my business district, Bankers Hill. I drive down the streets. I see they're building all over the area. So we have new condos that are going into the area.
Well, they were building in 2007 too, though. So sometimes that's a canary in the coal mine.
Of course, but still, I see boots on the ground. I see our construction guys working.
We're definitely seeing that too.
I think just across the board, looking at those types of things where you can actually see it, we're still expecting that growth, and that's just something you can see every day. Again, I think that the cautionary tale is people still aren't feeling great. Like, we haven't truly had that great recovery.
Yeah, but why is that, though? Because if you look at the numbers, I'm not asking you to be the guy who has to, commentary on everything, right? But specifically, we've got an average rate. The economy's grown an average rate of 2.2% since I think it was middle of the year 2009. And then more recently, we've got job growth. We've got economic growth. Economic growth is up 5%. I think that was just from last year. So why is the psychological element not quite? Is it about underemployment? Is it about the fact the unemployment still, while incredibly better than it was the last couple of years, is still not quite where people need it to be? What's your take on that?
I think it's all of the above.
Yeah.
Still, even though things are getting better, I think it's easy to look at the bad news, especially when you're thinking of your investments. Whatever's happening overseas, there's always been a reason not to invest. And that's, again, where I really help people to look at the true numbers and be realistic again about where their money should be invested. And going back, I think part of any well-diversified plan is going to include U.S. stocks, international stocks, bonds, and you're going to have a blended portfolio for any market cycle.
Yeah, it's interesting too. What kind of corollaries do you think? What you were talking about growth and stuff, and I was talking about how we're seeing a lot of growth over in the real estate wing of things too. What do you think about that as an investment class right now? It's almost kind of, and I don't know how true this statement is, but the perception sometimes is kind of like stocks to bonds. So sometimes real estate grows in lockstep with the market economy. Sometimes it's a little different. People kind of say, I want to park my money in something that's like an actual physical asset, that concept. What do you think real estate lives right now in everything we're talking about?
Well, as you know, you're trying to help my wife and I buy a property. So right off the bat, if you're going to live in it, always real estate has been strong as far as housing costs go. I think here in San Diego, especially, it being over the national, average. I think for folks, where I try to help them is in real estate, is what percentage of their income is their housing cost. And I think that factor right there, where I've seen people get into some trouble, is that their housing costs are a significantly higher percentage of their income than we would recommend.
Well, and typically folks that are trying to leverage that, and get loans, Fannie and Freddie, they like saying, hey, we get it, but we're not going to give you more than 42% of your, what they call DTI, your debt to income ratio, considering all debts versus how much is it going to cost you. Would you say that's a a fair benchmark?
I definitely think if somehow you are over that, again, that's where the real economy speaking, people get into some trouble when they are over that in their housing costs. So I do think if you're in the 30 to 40%, and you have money left at the end of the day that you can put into maybe a retirement account or in that account on the side, I think that's the best way to go. But by and large, thinking about real estate, I think, again, part of a well-diversified portfolio, especially if you are a higher net worth individual.
Or especially if you're renting.
Most of the time, people do have that as part of their portfolio, most certainly.
Yeah, well said. Well said. It's kind of one of those things. It's like you can't really. Well, you can, but it's more difficult to pass that up on the way to creating wealth. Because it's a great tool. It's a great instrument for that, is it not?
I wouldn't think there's a lot of renters out there, and I could be wrong, that have $1 million net worths. But if there's anyone out there and you've done a great job and you've got $1 million and you've rented, great.
That sounds like a perfect client for you. Yeah. Well, hey, listen, we're talking shop right now with my man Jake Sutton, Edward Jones Financial. Again, you can catch him at jake.sutton, 2 T's, at edwardjones.com or at 619-235-4219. And coming up, my favorite topic. The seat's gonna get hot. It's been tepid at best right now because we're gonna dig into interest rates. So stick around for that. We're going to figure out which way they're headed and how that's going to apply to your financial plan with Jake Sutton, Edward Jones. This is Jesse Ibanez. You're in the Stash, baby. Real Talk Radio, San Diego. We'll be right back.
Hi, Tom.
Hey, how's the college visit?
You remembered. It's good.
Does it make the short list?
You remember that, too. Yeah, I'm afraid so.
Knowing our clients personally is what we do.
It's okay. This is what we've been planning for.
Thanks.
Bye.
Bye.
And with over 13,000 financial advisors, we do it a lot. It's why Edward Jones is the big company that doesn't act that way.
What's happening, gang? You are live in the Secret Stash. I am your secret agent man, Jesse Ibanez, co-founder of the Greenhouse Group. And I'm flanked by my man, Jake Sutton today from Edward Jones Financial. And this is Real Talk Radio San Diego. We got you from your 1 to 2 o'clock hour right now, getting all smart and stuff, getting all financial planned up and stuff. Good opportunity right now with the first quarter just behind us. And, man, we've covered a lot of ground here today, my man. We got oil out of the way. We talked market. We talked stocks. So there's still some room left despite those big gains. Maybe some opportunities in international stocks. And now my favorite topic is interest rates. And, interest rates are interesting. I need a little button for that. Only because a lot of people have a tendency to lump together the two, and what do short-term rates and then long-term rates too, right? And a lot of times they behave independently or interdependently of one another. And then things have been so crazy lately, sometimes you've actually watched them behave similarly, like short-term rates go down, long-term, that whole thing. So why don't you give us a primer on where we are right now with everything in the whole rate game, and then we'll start talking about how you believe where we are versus where you think we're going to go is going to affect your plan. So kind of bring us up to current right now.
First, obviously, much has been made about interest rates and the Federal Reserve. If you watch the talking heads, that's all they talk about is where are rates headed, and people are going insane trying to figure out where those are going to go.
So it's clear that they matter.
Absolutely.
But we're going to sprinkle some consciousness and figure out how much so and where they do, right?
I definitely think, in our opinion, if you want to take the long view, obviously because rates are very low, that they probably are going to move up in the future. And definitely, I think people have been stashing their money, if you will,
sure,
in the bond market. And whatever bond market it happens to be, that people are in the bond market, and we think that they need to be. It's part of a well-diversified portfolio, and there's no doubt most of the time when stocks go down, bonds go up. But when rates go up, bond prices fall. And
when you mean rates, are you talking about short-term or long-term?
We think if you, again, take a look at our report there, we think that probably long-term rates will move up in anticipation of the Federal Reserve moving that short-term rate.
They're going to hedge the bet. We've already seen a little bit this year.
And I think we were talking during the break, definitely if you want to take a look at what that might look like, in 2013, rates did move
Yeah.
up. And so,
And that had a big play actually in our real estate market. I remember, I don't know if you can spot the date, but was it kind of springish?
it was June.
It was June, yeah. So everything was rocking and rolling, firecracker. And then all of a sudden, it was Bernanke actually. It wasn't even yelling yet. He popped up on the mic and said, hey, we're going to start looking at our QEs. We're going to start maybe the quantitative easing, the whole stimulus thing start maybe rolling back. It was a maybe. It was just a mention that it was even on their radar. And literally, he dropped the mic, like any good comic would. And the rates went up like 1 point in 1 week. Did they not? So is that reflected in that report?
Yeah, if you'll look in 2013,
Yeah, 2013 down 2%.
bond prices fell.
Yep.
So keeping that in mind, taking a look at that portfolio, especially if you've had a lot of success in bonds or maybe the longer term bonds, what will happen is if you have a 30-year maturity and rates rise by 1%, potentially your bond could fall about 14%.
Damn.
So here's the safe part of your portfolio.
Should I get Chris Rock in there for that? All right, no, Chris Tucker. Sorry.
I like Chris Tucker.
Sorry,
That's
Chris
great.
Tucker.
So if rates were to move up unexpectedly, then absolutely there will be, the markets will react. And again, that goes back to that emotion.
Yeah.
So you have to be ready for that.
Warren Buffett, I remember in one of his books I read, he talked about the concept of Mr. Market, because it's a human, emotional being just like we all are too. And so you had mentioned that almost kind of in anticipation of, so that's kind of an emotional thing, right?
Yeah.
It's kind of scientific, but it's kind of more you're hedging for the emotional thing. So what happens, let's say, everybody turns on the news and then the news says, hey, they're going to rise, interest rates are rising. They're talking about short-term rates, right?
Correct.
So that's the overnight Fed fund rate, basically, right? And then how do mortgages correlate with those?
It goes back to that expectation. So if they're going to raise rates, then potentially the economy is doing better. But all rates are based off some of those government bond rates, and of course, with the short end of that, it doesn't seem like they're going to raise it by 0.25%. That doesn't seem like much to you. But again, in anticipation, the longer end could move. And again, it all depends on people's emotions because the market does dictate those rates to some extent. And so it's an expectation that rates can and should be going up, that the economy can and should be doing better. And so that's where you could see some fluctuation in the markets. And also if you're talking about helping people purchase a home, auto loan, your savings rate, everything could be affected by all the rates put together.
Yeah, the overnight actually more directly because they tie into the revolving, of course, what you get your credit card, interest rates derived from, and then the installment rates like auto loans and stuff, but the mortgage-backed securities a lot of times are kind of on their own little island, but they can't go down any further. I mean, they could, but I mean, realistically speaking, we're about... when you think about inflation and everything, like historically, like this is, so they're only going to be going up. Would that be a pretty fair assessment?
I think that we've seen them lower than they are today.
Right.
So like
Slightly.
Take a 10-year treasury yield. We've seen it lower today. But again, we would agree with you. Really, we're not expecting, I wouldn't be holding your breath and waiting to purchase that house because you think interest rates are going to go down.
And that's what I was going to ask you about too. So, I mean, what's your take on rates as a corollary to affordability?
Definitely going to affect it. And you know more about it as far as in the real estate market than I do. But when rates go up, the affordability of housing goes down. So that's the bottom line there. Again, we'll go back. Even though we think rates are going to move up in our report, we're mentioning they're probably historically going to stay low for a while moving forward. But even any move up can affect that affordability and definitely can affect your portfolio.
And that's the key, too. You mentioned buyers a couple times, probably because that's where you're at right now, right? And so, you have a tendency to kind of see the world through your own lens. But what about the other side of that spectrum? So how do you think where we are right now with rates is going to affect potential sellers?
That's interesting. I hadn't thought about that. Obviously, you helped us sell our home, and it moved very quickly, and we appreciate all the hard work you put into that. I think I don't know what's in the mind of the seller right now. It would seem to me, looking where we're looking, and you can probably speak to this a little bit more, inventory still seems low. And I'm not sure that that's a function of rate or affordability or where that stands, or just we're not building as much here in San Diego as far as single family home wise goes. I see a lot of rental and condo markets, but single family seems tough. So that's where sellers' heads are at. It's too bad this isn't a call-in show. We could we could call a seller and see where they're thinking.
It's true. And, I'll even borrow some wisdom I heard you share earlier in a different context, which is, hey, man, it's kind of a confluence of all the above. Listen, one thing right now that I know for sure, which is troubling the average seller, is that they're in a spot right now where they might be looking at their equity and being like, finally, like we've been waiting for a decade for this thing to be worth what we thought it was worth back before the whole thing, decided to go take a hike. Back 2006 kind of was our peak, and then the fall off thereafter. So we're finally seeing those levels restored. But then the challenge is, where do I go? I don't want to leave San Diego, and then they're looking around. They're like, God, there's no homes to buy. I'm afraid to move, because then what? I don't want to rent, or I might end up in a house that I don't really like. So one of the concepts that I think we're trying to do to help our clients right now is the concept of sell then buy. And there's some very interesting dynamics at play, some very challenging logistics at play. So we decided to actually totally lean into the challenge, and we created a seminar. And by the way, if you want more information about that, go ahead and reach out to us directly. You can email me at jesse@greenmeansgrow.com, because we mean grow, baby. Greenmeansgrow.com. And I'll email you some information about when our next live event's going to be. But that's critical, because if you don't have information about how to get from where you are to where you want to be, you're not going to go anywhere. And you're going to be stuck right there with cement shoes. And that's part of the challenge of why the inventory is so low. So anyway, got some good tips on that. But before heading out, though, your overall take on rates is that they're heading up. And your overall take on affordability in terms of the buyers is that it could challenge them. Sellers, could you also argue, it might have a similar effect, because if affordability goes down, prices might go down too?
I agree with what you're saying. And I think it goes back, not to take it off the real estate and back into a portfolio, but I feel the same way. Investors potentially are still concerned. And again, it goes back. They've seen the market go up. They've seen the market go down. And if they hadn't made a move, they're still a little fearful about putting a good plan into place and a good allocation. So I think that where the market's at, both housing and into the stock and bond markets, that people do still have that concern.
Yeah, I love that thought. That's my man, by the way. Jake Sutton, Edward Jones Financial. You can catch him at jake.sutton, 2 T's, at edwardjones.com, or 619-235-4219. And this is the Secret Stash. So you better believe that coming up, Jake's going to share his one best secret that he wants to give away to make sure that your portfolio is right and prepped for what's heading upon us in the end of the 2015 campaign. We'll be right back. Real Talk Radio San Diego. Don't go nowhere.
If you missed any of the show, check out the podcast at secretstashradio.com. Welcome back to the Secret Stash with host Jesse Ibanez on ESPN Radio 1700.
Hey, what's happening, gang? You are live in the Secret Stash. I got my man, Jake Sutton, Edward Jones Financial, and this is Real Talk Radio San Diego. We got you on your 1 to 2 o'clock hour, hopefully making you super smart and stuff, at least getting your numbers all dialed up. And that's what my man is the best in the world at over here. And you can catch him, by the way, offline at jake.sutton. That's 2 T's at edwardjones.com, or directly him or Diana. His lovely Diana. Is she the id to your superego?
I guess so. I say she's my other wife. This is my other wife, Diana, Michelle, wife number 1.
As long as Michelle's cool with that
wife.
title.
She is.
That's right there on that. Okay, cool. Or you can call both of them, either of them directly at 619-235-4219. That's 619-235-4219. 4219. And man, are we talking plan today. This is the roundup, man. I prepped it before the break that Jake was going to unleash his secret, his one secret for you to have the best last 3 quarters of the 2015 campaign. And what did we do, man? We covered oil. We covered volatility returns, where you want to be, if that means you got to kind of pull back a little bit and plan and get a little liquid. We talked about stocks. You said domestic, man, they're going to still be coming up. International will be a nice opportunity to kind of flex your portfolio muscle a little bit. We talked about the economy, so there's still room for us to grow. Rates are going up. So what's your plan as a result or a corollary to that happening, and all kinds of nonsense in between. But now comes the good stuff. What's your one secret, brother?
I think the biggest secret, and so often when I ask investors or maybe someone who's thinking of hiring us, and by the way, we help out about 400 families here in San Diego.
There you go. And
we have capacity to help more. So many times I ask investors what rate of return that they had achieved last year, and 9 times out of 10, they don't know the answer to that. So the real secret is to find out where you are today, and we can help you do that. We have great tools using Morningstar, which helps us rank different investments. We have our portfolio tools, which can show you how you're diversified, whether you have those international investments, whether maybe you're overweight in a certain sector. And certainly we go through a process. So we have a process to find out what your goals are, where your risk tolerance is, and then we just see if those investments match up. And so that's the real secret, and that's where, if someone needs that type of service, that we certainly think that we're a great option to help them out. And that's a completely complimentary service, so there is no strings attached. If you just want to see where you're at, we're more than happy to help out.
So your secret's tools.
We have a ton of tools as far as just to make sure, again, that people are on the right track with what they're doing. And then, to plan to come up with an asset allocation strategy that makes sense for them.
So when you throw out names, I was way above my pay grade. Morningstar, asset portfolio. So let's say I roll into your office, I take advantage of one of your complimentary meetings. What's that look like? Are we looking at like a computer screen and you're like, and it's shooting me out what's going on? So maybe kind of give me a little peekaboo inside of what that actually looks like.
Sure. And another tool, I'm glad you came back around again. We have a lot of great resources about Social Security. I work with a lot of pre-retirees, and I hear a lot, Social Security won't be there for me. We think it will. There might be some changes coming there, but we have some tools, again, to show you what that might mean for your financial future. But when people come in, let's say they have sent us their material. So let's say they sent us their
So you guys wrapped out, you
statements.
shared a quick call, and then in advance, in preparation, they send over some stuff.
We have their 401k statement, let's say their IRA statement, their bank account statement. We can load that into Morningstar, and what comes out again is I can show you what rate of return you achieved last year.
Okay.
So I can back test again and see, okay, here's let's say you had 10 different mutual funds and a couple different stocks. I can show you what rate of return that you achieved last year. Also, Morningstar will, any fees or expenses that are on those investments, we can take a look and show you what you're paying.
Oh, that's important.
For those investments.
So the real cost as well as the performance.
Definitely, to make sure that that's not too high, or if you're again in a fund that hasn't been performing, something that needs to change there. And then again, we come in with our portfolio system that shows you, let's say you're 70% in stocks and you're 30% in bonds, and to make sure that return is what you should have received for a 70-30 split. And so we can show you some benchmarks and just say, here's what another portfolio would have done for you that's very similar. Maybe you get a better return, you pay a little bit less, you're a little bit more diversified moving forward. That is definitely how that goes. And then if you like what you hear, certainly we are taking new clients on, and we'd be more, again, happy to help anyone who needs our service.
No, and I know that you do. And what comes up for me is that thought of, like, the old infomercial king, Billy Mays, God rest his soul. You said it and you forget it. You remember that one, right? Not the case with financial planning, right? So it's not even to judge it either. It's like, because even if a year ago you cooked up the utopian scenario, right? It still needs to be cross-checked with what's real right now, like that concept of the cheese got moved, right? So it's constantly moving, is it not?
Yeah. We say buy and hold. Buy an investment and hold it.
Yeah.
But we don't forget about it.
Right.
So definitely when we come on a case and someone hires us to help them along, it's the review process. Where you are, where you want to go, can we get there? Can we stay there? That's what we're constantly going through. Some people, they want to hear from us every year. Other people need a little bit more hand-holding. So, some clients we talk to at least once a month because that's the level of service that, they're looking for. Other people like that quarterly review. We actually have a tool that's really cool. You'll love this. We now can do WebExes. So I can send a meeting request.
Oh, that's cool.
You can see my screen, and we can do everything. I still want to do everything face-to-face because that's really what
But
Edward
for some
Jones,
people, though,
busy.
Yeah.
You're a busy executive.
I'll be taking advantage of that.
A busy small business owner like yourself. That I think some of those meetings can now happen. I just did my first WebEx the other day with a client, and he really appreciated it. It's 9 a.m. on his day off, so that's the kind of service that we provide. That's
the kind of service that Jake Sutton, Edward Jones Investment, can provide. And listen, this guy, if you love the belly to belly, face to face, person to person, he's right over on Bankers Hill. Now more affectionately called Park West. You didn't know.
Yeah, we talk a lot about that.
Bankers Hill, right? You're in the bottom floor of the Mr. A's building, right?
We're in the Mr. A's building.
San Diego landmark Mr. A's. Everybody knows where that is. And you can catch him, as I'd stated before. Shoot me an email. Jake.Sutton, that's 2 T's, at edwardjones.com, or at 619-235-4219. Jake, thank you so much, my man.
Thank you so much
I appreciate you coming in.
This was fun.
Sprinkling your infinite wisdom upon all of us. And I know for a fact you found somebody better than how you left somebody better than how you found them today. And that's what we do in the stash, baby. We'll be right back here next week. We got you from the 1 to 2 o'clock hour. Real Talk Radio San Diego. More real estate talk coming right up. Thanks for hanging out.
Thanks for listening to The Secret Stash. If you missed any of the show, check out the podcast at secretstashradio.com. And we'll be back next Tuesday at noon right here on ESPN Radio 1700.